Hello, and thank you for joining today's webinar with Scope. Today, our theme is sustainable investment, a theme that has become incredibly popular over the last years, which is good. But sustainability is a very wide field with a lot of different approaches to sustainable investing, with significant differences where the managers place the emphasis on, for example, on investment themes like clean energy or climate change, or also the strictness of the approach, whether it's a very strict ESG approach or a very loose ESG approach, ranging from having just some simple exclusion criteria over best-in-class approaches to sustainability positive approaches. Each of these approaches can lead to a totally different portfolio, for example, in terms of sector or country allocation, the number of holding, concentration, market cap, or the overlap with the benchmark. But we all wonder, is there an ideal approach that works best and having the highest benefit for investors in terms of returns, and of course for the other stakeholders, like, for example, the society, the employees of the companies, or the environment? For today's discussion, we have two long-term experienced fund managers on board, Paul Schofield and Jeremy Kent from NNIP. They're here today to discuss with us the different aspects of sustainable investment and their findings in theory and the life management of their portfolios with us. The company NNIP is an expert house on sustainability with also a very long-term history of more than 20 years in that field. They've launched the first sustainable equity fund in the year 2000 and have kept on with it ever since, even when ESG investing was out of favor after the financial crisis. Today, ESG is even more integrated at NNIP on company as well as on fund level, and it offers a broad range of sustainable funds for investors. Before we start with our Q&A session, one technical remark from our side. You as the participants have the possibility to ask questions to the managers during the webinar. So if you have a question, please type it into the chat window on the right side, either in English or in German, and I would ask your questions during the course of the webinar to the managers. But now let's start with our Q&A session with the managers. So hello, Paul and Jeremy. Great that we have you here today.
Hi, Barbara. Yeah,
Hi.
Morning. Thanks very much for having us today. It's always a pleasure to talk about sustainable investing. So thanks.
Yes, thank you very much for being here today. So first, I would like to start with you as a team, because in September last year, we had some turnover in the sustainable investment team at NNIP. So 3 managers and a few analysts have left the team, and you were hired as 2 ESG experts. And therefore, I would like to ask you if you could tell us a little bit about yourself, your prior experience with sustainable investment, and why you joined NNIP.
Yeah, well, happy to, Barbara. Thank you. So as you've mentioned, my name is Paul. I joined as the head of sustainable and impact equities. So just fairly recently, as you've mentioned. Pretty much all of my working career, so despite the youthful good looks, over 20 years I spent at Allianz Global Investors based in London. Jeremy worked very closely with me as well at AGI, and obviously I'm very pleased that he's decided to join us as well at NNIP. Now, during that time, we were responsible for a range of global equity funds of various flavors, but the very large majority of which would be classified as sustainable. And by that, and alluding to a comment you just made, we mean a combination of really both negative screening as well as positive screening. And frankly, investing in this way for us, for both of us really, is just normal. So we haven't really done anything else. So again, just to pick up on, as you mentioned, we're probably a little bit more popular in the last 10 years than we were in the first 10 years, as sustainable investing has really gathered some strength. And we used to have just a global equity fund, but now as the theme has grown in popularity, the range has broadened and we have different regional funds, more thematic funds, impact funds, that sort of thing. So Jeremy and I are quite used to managing money in that way. Jeremy.
Yeah, so I came in on my history. As Paul already mentioned, was at AGI for 13 years. Started my career as an ESG analyst on the ESG research team there for about 3-4 years, and then transitioned to the portfolio management side, where I managed the global sustainable product with Paul for the last sort of decade or so. Was also part of the proxy voting and ESG committees at AGI, which have carried through to NNIP, being a part of the proxy voting committee here. And I think on your latter point, just on why NNIP and the attraction there, I think, Barbara, you already mentioned the sort of expert house and long history and track record that NNIP has. And I think from the external perspective, that's very clear and evident. So that certainly was a good starting point. But then secondarily, I think the more intangible elements, once you sort of speak to the people involved and across the organization, it's not really just that talking the talk, but also walking the walk throughout the organization. So really sort of attractive from that perspective.
Yes, thank you very much, both Paul and Jeremy. So I was wondering, as you were in a similar role before at Allianz Global Investors, so I was wondering, did you follow a similar approach there, and have you changed the investment processes at NNIP, or were there a high compatibility?
Yeah, the beauty for me really about moving to NNIP is that the investment philosophy within both teams, so Allianz Global Investors and NNIP, is almost exactly the same. The key focus on quality, and by quality that tends to be a strong focus on returns. Can a company generate a return consistently above the cost of capital through the cycle? And can they grow those returns? That element of compounding of returns tends to be good for shareholders. And of course, the ability to continue generating these returns into the future, i.e. the principle of sustainable competitive position, that defendable moat, that's very, very important. So the investment transition has been quite simple because it was pretty similar.
Thank you very much. That sounds really good. So NNIP has a lot of resources in the ESG space. Speaking of a team of dedicated ESG research analysts dedicated to managing ESG portfolios, and also a responsible investment team on company level. So could you tell us a little bit about how the collaboration works with each of the teams?
Yeah, perhaps I'll come in here, and I guess I would characterize it sort of at two ends of the spectrum as far as our investment process and approach, and one being on the front end of the process, and Paul's kind of already touched on the screening element that goes into the investment process and really filtering down the universe of companies that we're looking at. And that's where we utilize one of the tools that the responsible investment team is responsible for, a tool called ESG Lens, which effectively ranks and rates corporates as well as sovereigns based on relevant ESG criteria. So this is a really helpful tool, again, on screening for companies that would be attractive to us from a sustainable behavior perspective, which is ingrained really in the philosophy and in the approach that we have, and really trying to target and be exposed to these companies, but also trying to avoid those companies that don't demonstrate those sustainable behaviors and perhaps as sort of bad ESG actors from that perspective. So really helpful tool. It gives us that sort of arm's length relationship as well, in the sense of we don't have control over that ESG ranking, and it's sort of independent of our team. So put some discipline in that initial process. The second element that I would probably touch on, where we're very integrated with the responsible investment team and working together, is after that portfolio construction element is completed, and following through with the active stewardship, which active stewardship really involves engagement as well as the proxy voting side. And again, on both of these elements, we're working collaboratively with the RI team. On the proxy voting side, the RI team has developed and maintains the overarching proxy voting policy that informs the voting of NNIP. But then we also sort of collaborate and discuss specific AGMs or votes that are occurring to determine how best to achieve the objectives that we're trying to with our clients from a voting perspective. And then finally, on the engagement side, again, this is an area where we can work closely together with the responsible investment team to tackle engagement with the companies that we're invested in together. The responsible investment team tending to sort of approach from a top-down perspective, where they're looking at themes as well as controversies, and from the portfolio management side, we tend to have more of a bottom-up perspective from engagement that that goes on within the portfolio. So where we voted against management, where we see scope for improvement from an ESG side in the companies that we're exposed to, tends to be the drivers of the engagement within the portfolio. Hopefully that gives a bit of a flavor on the sort of interaction and cooperation with the responsible investment team, particularly.
Yes, thank you very much, Jeremy. So it sounds like a profound approach of looking for ESG information from different angles, as you said, from your side, from the bottom up mostly, and from the responsible investment team, from the top down mostly, and also having like an independent check for your opinion within the company. So we have spoken about a team. The next thing I would like to discuss on is sustainability investing in theory and practice. And I would like to start with the theory because we are all wondering, is ESG investing really producing above average returns? Sometimes I have the impression that it goes along with quality, so that quality and ESG go hand in hand, and that results have been better indeed. But I would like to ask you, especially that there have been a wealth of academic studies been published over the last years looking at all angles of sustainable investing. And I would like to ask you, what insights did you get from these studies? And for example, is there a separate factor which is discussed, a separate factor premium for sustainability, and whether it has been consistent over time? And also how sustainable investing has influenced the risk-return profile of the portfolio?
Yeah, maybe I'll start with this one. You're right, Barbara. I mean, there's been well, probably 10 years ago, not an awful lot of academic work had been done on this area of investment, but that's certainly changed in more recent years. To sort of bring it all together, I suppose, a very significant majority of that work, perhaps about 3/4 of that work, has reached a conclusion that incorporating ESG into your investment process is positive for risk-adjusted returns. Doesn't tell you how positive, but it's positive. Probably 20% of the research that we've seen over the last few years would suggest that there's no impact on returns, not positive or negative. And the rest, say 5%, a very small minority, has found that there might be a negative impact on returns. So overwhelmingly neutral or positive, I suppose, is what we've generally seen. There's been a very clear consensus that the governance element of ESG has been of most value add historically, although I suspect that might be changing a little bit now. The research has typically shown that incorporating ESG into your investment process works better in certain markets versus others. It's very, very strong in emerging markets, for example. But again, the overall data and disclosure landscape is rapidly changing, and hence much of the academic work might need to be revisited in the future, as there's a lot happening around the world in that space. So, and actually on that, I suppose when we try and link that to more practical ways of assessing and harnessing ESG, one way we like to look at things, we have a belief that ESG momentum, if harnessed correctly, can be a powerful way of generating alpha. And the academic work would back that up. By buying companies that are perhaps average at managing their material ESG risks, but where the direction of travel is positive, that can be powerful. But to your point on quality, for me, a company with good ESG practices is simply a better, higher quality company. So if you can catch a company on the turn, if you like, the investor perception of that business is that it's moving from a low quality business to a high quality business. That usually comes with a re-rating in the marketplace, and that tends to be good for shareholders. So that's kind of what I would say off the bat. Jeremy?
Yeah, I mean, I think you touched on the main points there, and I guess just fleshing out maybe perhaps the governance issue and the data disclosure. As you mentioned, these studies are reliant on external data or data providers typically, and the correlation between these data ratings tends to be very limited. So I think there can be quite a bit of divergence in the studies, but as that data improves and as we see better disclosure from corporates, the ability to measure this sort of performance implications becomes better and better over time. but we're still a long way from disclosure on a lot of the elements that we look to, that we feel are material to the business. For example, fatalities as an example, which arguably is a pretty material issue to most corporates. If there's deaths within the business, it's sort of less than a quarter of the MSCI World report on that figure. So there's still this data gap in the ability to sort of have this real in-depth quality sort of analysis of how these ESG factors affect performance over time. So, but getting better and better over time.
Yes, thank you, Jeremy. I also had the impression that the data is improving vastly, or has improved vastly over the last years, depending on the depth and the breadth of data you currently get about ESG investing, which also helps to verify our findings. So the next thing I would like to touch on is the best approach for ESG. So you have a long-term experience with sustainable investing, also at your prior employer. So I'm wondering what you think works best in ESG investing. Did you conduct some analysis in the past, how different elements or criteria in an ESG approach influence risk and performance? For example, regarding the E, S, or G criteria, or maybe the strictness of the ESG approach. Is there an ideal approach, I'm asking myself, and how does it look like?
Sorry, pressed the wrong button. Yeah, I mean, that's a very good question. I think the short answer is that if there's one ideal approach, the short answer is no, there really isn't. You can unpick ESG or sustainable investing in many different ways, and that lots of our competition or indeed ourselves all have slightly different sort of views on how best to incorporate it into your investment process. We all think generally in the same way this is positive for you, but how you actually do what you do is quite a challenge and varies from investor to investor. So there's no one sort of holy grail, if you like, of a way of doing things. But there are areas that are much more powerful than others. But as you said in sort of your question, because the data landscape is changing so significantly, what we think is working best now might not necessarily be what will work best in 4 or 5 years' time. So let me try and give you an example. We've historically seen that in places like Japan, the data disclosure historically has been very, very poor. And slowly, very, very slowly over time, that is just chipping up and getting better and getting better and getting better. And some of that is down to regulation. Some of that is just down to investors getting a bit grumpy and a bit angry. And a lot of investors who have a quality tilt just haven't really invested in Japan because it's not there. There's no data there that you can get your teeth into. But the corporates in Japan are learning, and they want to open up their shareholdings to investors all around the world. And they realize they now have to do something a little bit more, or get on the front foot a little bit more in terms of data disclosure. And that is starting to trickle through into the numbers. Now, what does that mean? Well, that means Japan, for a sustainable investor like ourselves, starts to become investable again. And so, 5 years ago, I probably wouldn't have spent a moment talking about Japan. Now, actually, it's really quite interesting. And you're starting to see really good Japanese companies, really high quality. The financial returns are there, but also the sustainability of those businesses is also there. So it's changed. The landscape has changed dramatically from that sense. Does that mean Japan is going to outperform over time? Well, it's got a better chance than perhaps it would going, if you look back 10 or 15 years. So a sort of long-winded answer to a question, just reiterating that this is not an area that stands still. This is not static, and we're still learning and still evolving the best practice, really. But it really boils down to what your underlying client or the investors really wants to achieve with their savings, with their investments. That's the important question. And if you tell us what that's, the answer to that question, then we can find the right strategy. It might be passive, a passive sustainability strategy, might be active, it might be impact. So there's lots of different offerings, but it really depends on what the clients want. That's a very long answer. Apologies for that.
Well, maybe just to make the long-winded answer even longer, I think maybe shifting slightly from ideal approach to more the consistency of approach, I think that has happened is this focus on materiality, which really seems prevalent in either investment approaches or even the sort of regulation that's coming in, where the real intention should be to focus on what is the material, environmental, or social factors that impact the underlying business, and that's where the data disclosure should be. That's where the analysis of the corporate should really be focused on, is on the material elements to the business, rather than just taking a blanket approach to every single company. So yeah, perhaps not ideal in that everyone's going to have their sort of different approach in terms of defining materiality and how they approach materiality. But I think certainly from a consistency perspective, there is this level of consistency around focusing on materiality and what's material to the underlying business.
Yes, thank you very much for pointing out the materiality. So there is no one-size-fits-all approach, unfortunately, and also the landscape is also evolving over time, and also you have to look at the company-specific ESG factors, which are most materials for the business. So it's a bit tricky. And my next question also wants to touch on something Paul has said when answering the last questions. So I'm wondering why you offer different solution to clients. You have, for example, ESG enhanced passive funds, ESG positive actively managed funds, and dedicated impact funds. So how do you differentiate between these processes? And also, what is your view on the active passive debate when it comes to sustainable investing?
Yeah, I mean, two good questions. That last one we could debate for hours, but I'll come on to that in a second. Let's take the enhanced passive funds out of the equation just for 1 second. The actual investment philosophy for our sustainable range and our impact range is very, very similar, i.e. back to what I mentioned earlier, trying to find those higher quality businesses with good returns and some growth, and allowing those returns to compound over time. What is different, however, is the impact funds need to see material and intentional impact against one or more of the sustainable development goals that you'll have heard of. For example, SDG number 7 focuses on affordable and clean energy for all. The sustainable funds don't necessarily need to do that. They can, but they don't have to. More practically, the impact funds have more flexibility to go down the market cap a little bit more in their search for those more impactful companies. So the basic premise is we are trying to find good companies to invest our clients' money in. We do not want to lose our clients' money, and if they can get some growth elements from the sustainable development goals, then great. But the impact funds have a very clear and defined philosophy, I suppose, whereby we need to see material and intentional impacts in the companies we invest in. Sustainable is less direct than that, I suppose. The enhanced passive range is obviously a little different again. And the way I like to think of this range that you said, this product lineup, is that we have something there that caters for a whole range of potential clients. From those looking to perhaps dip their toe into sustainable investing, they may prefer, and I'm slightly generalizing now, but they may prefer a passive investment initially to gain exposure to the equity markets with very low tracking error, comfortable that their investments are doing no real harm. Those a little more comfortable might prefer taking a bit more risk, and the active sustainable range might be their preferred approach. And then finally, an investor might want to have their savings or their investments to be directed towards a particular issue that they have strong views about, whether that's climate or health. And there we have more targeted, impactful solutions for them. So really, what we like in companies that we invest in is very similar across those ranges, really. But actually, they are calibrated with an individual investor and their needs in mind. So again, not one-stop shop. There's not one solution that works for everyone. We have to be sort of really make sure that we understand what our client needs, and then we'll have the solution to fit those needs. Does that make some sense?
Yes, thank you very much, Paul. This is a very valid explanation, because we also see this in practice, that we have some investors, like for example institutionals, that like it to cling closer to a benchmark, whereas some private investors, they want to have the maximum positive impact and sustainability, so they maybe would decide for an impact investment. So that makes a total sense. But the next point I would like to touch on, which wonders me, is how those funds have developed over the last years, including the COVID crisis last year. So how have they performed, maybe versus a non-sustainable global equity benchmark?
Yeah, and that's a great question. We're often asked that, and it's an easy one. I'm gonna, I'll have a smile on my face as I answer it, because performance for all of the active strategies and obviously the passive factor strategies has been pretty strong over the last couple of years, including through the COVID period. The market's certainly rewarded higher quality companies, and also those companies with some growth, and hence, all of our funds and that style of investing, they've all done fairly well from an absolute and a relative sense. Your point about mainstream benchmarks, if you like, we all of our funds are measured against mainstream normal benchmarks rather than a sustainable benchmark for various reasons, and we've stood the test of time over that 20 years, but also in the more recent past, because of that style element, that quality element has really helped. I think, Jeremy's just popped the slides up here. You can see the track records of the Global Sustainable Fund and the European Sustainable Fund, both the fund return and the benchmark return. And the benchmark in this case is the MSCI World, so not a green benchmark. So you can see that sometimes the investment philosophy is very helpful, and that quality edge and that growth edge that we have has been rewarded by the market for several years now. More recently, as the market has moved into sort of thinking about the future and a rebound from the COVID-endured macroeconomic slowdown, there's been a bit of a shift towards more cyclical sectors, commodities, for example, as well as towards more value sectors, perhaps lower quality sectors as well, banks, oil and gas companies. Neither of those really sits very comfortably with an investor like us. So that's made performance in the very short term a little tougher, but actually, we're managing to cling on to the benchmark-like returns over the last couple of months, despite those headwinds. And we feel that scenario is coming to an end. So a nice picture to share with you, and that quality element, right back to one of your first questions. An ESG company as a company that manages its ESG risk well is just higher quality, in my opinion. And certainly when markets get in stress or people start worrying about the direction of markets, that quality tends to stand you in good stead, and you tend to relatively outperform falling markets. So it's that's been very helpful to us.
Thank you much, Paul. Yes, it's really visible that sustainable investment has done well over the short term and also over the long term, and also in different areas of the world, like in this example, Europe and global. So my next question is about how NNIP integrates sustainability into the equity analysis. So could you please give us a company example, and also maybe touch a little bit on the fact that we have many companies now issuing an ESG report, so it's a default option for every major company, I have the impression. So might be that they also use these reports to tweak their ESG performance and make results look better or smoother over time. So like in the past, like they did in accounting. So how do you scrutinize these companies during your process to avoid maybe greenwashing?
Yeah, maybe I'll start with the answer there, and Paul, do chime in. But I think it's really back to that point we made around materiality as the starting factor in how we're assessing the companies that we look at. So as bottom-up stock pickers, we really think that's the value that we can add by understanding the companies and corporates that we're exposed to. So really having that intentionality as far as the material issues that are impacting a company. So, in terms of the process side of things, that starts at the ESG rating side for us. So as I mentioned before, the ESG lens, which already takes account for the materiality of factors of a given business. So, for example, for a financial institution, the focus is really going to be around the human capital element, how the employees in the business are, as well as the behavior of the business. How the business is governed tends to be a very important factor for financial institutions. Whereas for an industrial company, for example, where it's manufacturing heavy, it'll be much more emphasized around the environmental factors, so the energy use of the business or the water used. And again, that analysis really tends to center around either the direct actions or impacts of the business, so how the company manages its direct actions, or the externalities of the business, be it something like carbon emissions that's ultimately the company should have some societal responsibility for. But also increasing regulation means that there's going to be financial implications for these actions as well. So that tends to be how we frame the companies that we're looking at, and again, starting with the ESG lens, but then we have dedicated analysts as well that know the companies very well, know the specific ESG issues that are impacting the business, and really delve into those factors to understand and assess businesses from that side. I guess the second part of your question around greenwashing, certainly can be difficult. Although again, that sort of increasing data makes it slightly easier to assess that. And I guess in terms of how we tend to look beyond that or try and assess greenwashing or not, I think there's a couple of elements to that. One would be, in investigating the claims that a company's making. So if they're claiming they're a great employer, for example, go in and see how the engagement surveys, for example, are, rank a company, or how the employees rank the company, or external rankings, Glassdoor or others on that to get an assessment of the company. So again, investigating the claims that a company is making. Secondly is trying to seek assurance on the data that's reported. So again, is the ESG data audited, for example, by a third-party auditor? That's becoming much more commonplace in reporting. So it gives you some level of assurance that it's not just the company sort of pulling the number out of the air and reporting it, or using a robust methodology such as the Science-Based Target Initiative on the emissions side. Again, it just gives some level of certainty around the figures that are being reported and the seriousness that management or the companies are taking. And then the third one is around engagement with the companies, and I think you can get a strong sort of flavor of whether or not a company is serious about the ESG issues that impact the business or not. And I suppose just looking to examples from the past and speaking to management in the past, for example, an industrial company that we spoke to in recent years, pulling them up on fatalities within the business. The sort of CEO of the company came back and was surprised that they even reported that number. So wasn't even aware of the fatalities that were reported in the business, was unaware of them sort of underperforming peers. But then the flip side being a sort of telecom company that we were invested historically, also asking them about fatalities, is an issue that was brought up at the quarterly board meetings that they had, and again, just gives you that sense of this is a material issue to the business. They are managing and trying to drive this down, which ultimately should impact that quality of the business over time. Again, if we think this is a material issue, such as fatalities, which we certainly do, and especially within sort of telecom companies, then improving or being aware of these issues within the business should ultimately improve quality over time.
Okay, thanks for summing that up for us. So yeah, it's really important not only to look at the numbers, but look for verification of the numbers. So it's really vital that you do your own research on the company. And to me, it looked like a big puzzle. So bringing different parts, like a 360-degree review of the company together to form one opinion, for example, from the press, through own research, through the data, through external auditors. So it's really something where a qualitative approach adds value, like you're doing. When speaking of reporting, not only the companies have ESG reports, but also clients would like to have ESG reports. So also NNIP has some client reportings on the exposure in different ESG areas, like carbon or waste. So could you please touch a little bit on what insights NNIP offers here and where it places its emphasis on? I think we also have a slide in there.
Yeah, definitely. So I'll refer to a few slides here, and this, I mean, coming back to one of your first questions, actually around sort of enhancements or changes to the process. There is some great reporting that's already being done, but we also hope to increase the level of reporting and sort of enhance the transparency on ESG issues from the portfolio perspective. And I guess taking one step back as well, the reporting side of things, obviously regulators and clients are increasingly expecting this, but for us it's really important that the metrics that we disclose and report feature as part of the inputs to the process. So these should be intentional outcomes of the portfolio. It shouldn't just be by accident that we're performing as we are on these issues. So we do try and be intentional in seeking out those measures or metrics that are featuring as part of the analysis of that goes into the building of the portfolio and construction of the portfolio, either from that ESG lens perspective that I mentioned a few times, or from the fundamental analysis that's being conducted by our analysts. So that hopefully sets a scene on how we sort of think philosophically about the reporting and what we're trying to do there. And I suppose referring now to the slides, you can see the metrics that are currently being reported and heavily around the environmental side of things, and part of that being because the level of disclosure there has historically been much better than some of the social or even governance elements that we've seen. So you can see the sort of scope 1, 2, and 3 intensity of the portfolio versus that of the benchmark, as well as the waste intensity and water intensity of the portfolio versus the benchmark. You can see it scores very well from an environmental perspective, which is great. A great statement of, or proof point that we are doing what we're saying we're doing in terms of looking at these factors, and the output of the portfolio is also demonstrating that. But perhaps what might be a little bit more interesting, the metrics that again we are intending to expand on the level of metrics that are being reported. So just a couple of indications here from the governance side. So for example, the board diversity, which is used, or we have percentage of women on the board used as an indication of board diversity. There's a number of different measures that can be used, but again, from that data disclosure side, women on the board tends to be the best or most available data set that we have there. So again, gives you an indication there. The right-hand side is a social indicator, which is the lost time injury rate of the portfolio versus the benchmark, which is the number of injuries per 200,000 hours worked, and again gives you a sense of the sort of health and safety issues at play within a company. Again, look relatively good on that measure. However, from a sort of usefulness as this reporting as a tool, what becomes more interesting is areas where perhaps we underperform. So if we were to delve into that injury figure down to the sector level, sector exposure, for example, while at the aggregate level, the portfolio outperforms the benchmark, you can see at the sector level, there's a couple of sectors where the metrics underperform the benchmark. And that certainly is going to be the case with a wide spectrum of metrics, where we're not necessarily going to outperform on every single ESG metric out there. However, if we feel it's material, then we can certainly use this reporting, use this data as a tool for understanding the exposures, but also acting on those exposures. So, for example, within consumer discretionary, you see there the portfolio is worse than the underlying benchmark from an injury perspective. One of the drivers of that is Compass Group that's held in the portfolio, and really our job is to understand why that is, the context of why that exposure or that performance is there. You can see it's very small, I think, on my screen here, but the trend in the injuries at the business has come down pretty significantly over time. So the last 5 years, they've nearly halved the level of injury rate in the business. So certainly they are doing something about it. There is some movement on this. It's not trending in the wrong direction, let's say. But also from a fundamental understanding of how the business works, the exposure of their employees tends to be in more injury-prone activities versus other companies that would be part of that consumer discretionary set, such as an apparel retailer where somebody's sort of standing behind a shop till and less exposed to injury. So we do have frame that context of the business exposure, the trend in injury rate. But then the last step is really following that through with the engagement side of things, and seeing how the company is either setting objectives around the safety issues in the business. Are they intentionally reducing the number of injuries in the business? What sort of cost implications or cost saving implications it may have to the bottom line can also be an interesting insight from this exercise as well. And again, really just trying to use this reporting not only as a means of reporting the exposures of the portfolio, but as a tool for the active stewardship and overall improvement of the portfolio. Sorry, very long answer, but hopefully it gave you some insights on sort of certainly where the disclosure and reporting is and sort of intentions going forward.
Yes, thank you very much, Jeremy, for showing these examples of your reportings. I find it very insightful. And yeah, it's also a good discussion point with the companies, because they might be more open to discussion when they see the figures. When they see that they are below average, maybe they should be more open to tackle these issues when they want to be part of sustainable portfolios in the future. But of course, you have to look behind the numbers, because companies are really different by their business, and sometimes their business is more prone to injuries than others. So I think it's a good thing you're reporting, and I can imagine that in the future we will get even more granular data, or even new fields where you get data from. So looking forward to more of these reportings in the future. The next thing I would like to touch on is the outlook. But before we move over to that, I would also encourage our audience, if you haven't, so please enter your questions into the chat window, so that because it looks like we have some time left at the end of the webinar to answer your questions. So please feel free to enter your questions, and we will get back to them later. So the next point is the outlook. So I would like to ask you both, in which market segment you expect the highest growth rates in sustainable investing? Are it the ESG enhanced products, the ESG positive products, or maybe the impact products? And what is, in your opinion, the influence of the new SFDR regulation on investor decisions?
Yeah, that's a great question in two parts, really. Now, we've seen strong flows into each of those strategies over the last 12, 18 months particularly. I suppose if you're looking forward, I wouldn't necessarily predict one being better than the other in terms of flows. Sustainable investment, full stop, it is still quite a small portion of the overall pie, and hence market share can grow for all of these segments. The impact strategies are probably a bit newer and perhaps less well understood by many investors out there. So they'll probably have additional tailwinds as they tend to appeal to, or headwinds and tailwinds actually, because they tend to appeal to particular investors with a particular goal, and perhaps that could limit their growth. But also, that's just as they're being discovered and uncovered, that could attract some investment as well. So I think they'll likely do fairly well. But I think all of the strategies that we have and other our competition have out there in the sustainable world, we should all do well over the coming years and decades even, because what we're trying to do here is not reinvent the investment wheel. We've talked a little bit about the fundamentals of businesses, about that returns profile. We are still analyzing companies in just the same way as everyone else has done historically. We're just adding a little bit of additional emphasis on material, environmental, social, and governance risks. So we're just enhancing what was already in place from a process perspective 20, 30 years ago. So we're not reinventing the investment wheel. It's just putting a little bit more focus on areas that perhaps have traditionally been overlooked. And those areas are becoming more and more significant. So I think, if you don't have environmental, social, or governance factors in your investment process in some way, shape, or form going forwards, I would confidently predict that you will disappear. It's become that important. So to sort of back that up is to the second half of your question, where we talk about something like SFDR. It's certainly a very big focus for us and our competition. And yes, in Europe, it will certainly play a big part in investors' thinking, and will perhaps harmonize some of the products on offer there, harmonize the instructions on the tin, if you like, and make sure that investors understand what it is we're providing for them, and speak in a common language about what we mean by impact and what we mean by sustainability. Outside of Europe, it's obviously less relevant. It's a European regulation, and the regulatory landscape is ever developing and evolving. I doubt we'll ever see one global standard, but we can hope. So the outlook really for ESG generally is very positive, in my opinion. And the regulators and our, the retail investor, the institutional investor, they're all on board because we're not doing anything particularly different. We're just focusing a little bit more attention, paying a little bit more attention to the environmental and social, particularly those two metrics that historically haven't been dwelled upon, if that makes some sense.
Yes, makes totally sense to me. I also have the impression that it's still a huge theme, and we also see it in our regular reports. Scope publishes in the ESG funds the development of the number, but also the development of the assets under management that are rising sharply, and also that people, they think more about the impact of their actions also in investing, and even more companies banning like traditional energy, coal investments, for example, and even moving a step further, maybe looking at more factors than just the environmental factor. Because over the last years, I had the impression that the focus was more on the environmental part in the funds. And it makes sense because climate change is the most important thing over the next years and decades to come to tackle. So it makes total sense. But do you see other themes or trends gaining momentum at the moment, which are maybe still a bit small? And what do you expect to come up next in sustainable investing?
Yeah, I mean, I absolutely agree with you. I would just say here that you and I are both on the same page, and we would both agree that we're in some kind of climate emergency. But there's still many people out there who don't believe that. So we're still trying to win over some of the skeptics in that area. But I would absolutely agree with you. The big focus in recent years has been on the E in the ESG. Good corporate governance, the G, has always been well accepted, and we don't often get much pushback when discussing this with clients or prospects. But actually what the COVID era has perhaps done as a positive, if you like, is to shine a bit more of a light on that social element, so the S. People have got more focused on the workforce, on health and safety, on training, on education, and those areas historically, and perhaps oddly, weren't really discussed very much. So that's changing quickly, and I think that will become or remain and become more of a key focus. Flexible working, improved communications, issues like mental health and stress will remain in focus. And whilst these are tricky topics perhaps to discuss at times, and the data surrounding things like mental health is undoubtedly poor, I think a good employer will handle these areas and the welfare of their employees very well, and that will likely benefit them in the medium to longer term. So I think we're starting to see that shift towards the S, the people, which really, it's odd to me that we don't focus on that too much historically. We are people, we should perhaps be at the top of the list. But the COVID has actually shone the light a little bit more on people's, your workforce and their welfare. And I think that will become a trend where the data set gets better, we can analyze it better, and it will filter down to the bottom line, because some companies are handling this situation a lot better than other companies, and some companies are now on the I don't really want to work for them sort of bucket, and some wow, that looks like a really good place to work, so I think social is where we'll probably go going forward. But Jeremy, you might disagree.
Yeah, no, I mean, I just very briefly adding in one other theme that I think has gained a lot of momentum, and perhaps in part due to the sort of remote working and sort of greater digitalization is the data privacy and security issue. Certainly, we've been focusing much of our attention on that issue. I think it's become much more relevant to corporates across the board, not just sort of technology companies, but again, as more and more companies work virtually or digitalize their business, this just becomes a growing theme and topic for businesses across the board.
Thank you very much, Jeremy and Paul, for your outlook on the sustainable investing space. So there is more to come, which is good, and the momentum is going to continue, hopefully, over the next years and decades to sustainable investing. I think we are now at the end of our webinar, but I would like to ask a question from the audience, which has occurred, which I think is a really interesting question, because it is about commodities sectors. Commodities have had a rally over the last months. So are your funds allowed to invest in that sector? And are there companies that you favor?
Yeah, that's a good question. We only ever get asked questions like that when the particular sector has outperformed, which you're absolutely right. Commodities have done in the very recent past. The short answer is: are we allowed to invest in them? Yes. I mean, there's no exclusion, with the exception of things like thermal coal. We can still invest in a company that produces copper. We do need copper. You don't build a hospital or you don't build a road without copper. So we can invest in companies like that, but we would only invest in the ones that we think particularly manage their environmental risk really, really well. So they're not off the table. Have we had much exposure? No, not particularly. Why is that? Well, it's back. I'm sounding like a broken record, really. You know, we like companies that generate a return above the cost of capital over the cycle. And within commodities, oil, copper, whatever, these companies tend not to be able to do that. So an oil company or a copper company, when the oil price is high, these companies can make good returns versus the cost of capital, and that can be very, very attractive. When the oil price is very, very low, they make dreadful returns, negative returns. That's the same in copper, it's the same in iron ore, same in steel, for example. So the consistency of that returns profile just isn't there for us. So we're very, very unlikely to invest in a company like that. Now that, again, could change going forwards if companies, you know, sort of manage their business in a slightly different way. But at the moment, that consistent returns just isn't there in some ends of the portfolio, and commodities is particularly one. So it can be a little bit of a headwind for performance, but it tends not to be there for too long. Jeremy?
No, beautiful answer.
So thank you for that. Yes, I totally understand. When you look for predictability of returns, commodity is really not a good example for consistent returns because it depends too much on price movements, on commodity price movements. So another question I have is on SFDR. So a participant is wondering whether the sustainable equity funds and the impact funds are SFDR or SFDR 8 or SFDR 9 funds.
Jeremy has SFDR tattooed on his arm, so I'm going to throw this open to Jeremy.
The short answer is Article 9. So they are classified as Article 9. Can elaborate in that, but I mean, we're still very much in the early days, let's say, of the requirements and progression of how that all falls out. I have the sort of lucky ability of sitting on the work stream internally on regarding SFDR. So, you know, it's very early days in the development of sort of reporting and what this looks like. But certainly the sustainable and impact funds, the whole sort of suite is Article 9.
Thank you very much. I think that answers the question. It was a pretty binary question. So thank you very much, Jeremy and Paul, for being here today. It was great to speak with both of you, and you offered very valuable insight to me and also for our audience. So great that you have you here today. And also many thanks to the audience for being here today, and also for your questions. I just wanted to add that you will find all fund information as well as information about the next upcoming Scope webinars and of course the webinar replays on Scope's fund platform, www.scopeexplorer.com. So thank you all. Thank you, Jeremy and Paul. It was a great webinar. I hope you have a great day. And also, I hope to see the participants at one of our next Scope webinars. So thank you all and have a good day. Goodbye.
Thank you, Barbara. Bye-bye.